I think silver has pretty much had a lot of its pullback already, and I'm not saying that it has and it can't go lower, but I'm just pulling up a chart while we're talking. I mean, it looks pretty solid. It is a little bit overbought here now as well after today's little bit of a rally, which is almost $1. Again, I think we're stuck probably right now between 30 and 32, but I would not be surprised at all if we saw 35 by the end of the year, and maybe higher. But again, I don't like to make dramatic projections of where it's gone. I mean, I think someday silver will take out the $49 high, which was made, I think, in 2011. But right now, I'm looking at it one level at a time, and it looks pretty good. It's come off the bottoms, which was about 27, and has now rallied nicely. The key here is going to get through this resistance level here. But I think, listen, I'm a big believer that the precious metals, gold and silver, you may need them as a currency at some point here.
The precious metals market is abuzz with optimistic forecasts. Experts predict significant growth for silver and gold in the coming years. Todd "Bubba" Horwitz, a veteran trader and market analyst, leads the charge with a bullish outlook on silver prices. Horwitz believes silver has completed its pullback and may stabilize between $30 and $32 in the near term, with the potential to reach $35 by year's end. His long-term view is even more optimistic, projecting that silver will eventually surpass its 2011 high of $49. The silver price is now retracing its recent gains from the previous session, trading around $31.80 per troy ounce. Other market forecasts echo this positive sentiment for silver. A pitchfork analysis projects silver prices to range between $34 and $50 by 2025, citing the metal's growing role as a preferred store of value globally. While the gold market also shows signs of strength, Horwitz urges caution. He warns that extended markets often collapse, noting gold's rise from $2,400 to $2,550 in August. After its recent climb from $2,500 to $2,650, he expects a pullback to around $2,600, viewing this as an opportunity to attract new buyers and support a move toward $3,000. Spot gold's positive bias continued Wednesday, as the bright metal traded at $2,670.43 a troy ounce. The $3,000 milestone for gold is increasingly becoming a focal point for market bulls. This optimism is fueled by expectations of monetary easing from major central banks and the anticipation of a competitive U.S. presidential election. Akash Doshi, head of commodities for North America at Citi Research, adds weight to this bullish sentiment. Doshi predicts gold could reach $3,000 per ounce by mid-2025 and $2,600 by the end of 2024. Before diving into the video, subscribe to our channel, hit the bell icon, and share it with others.
Gold is going higher because inflation is going higher. That's the relationship, right? Now, I'm not a big believer of correlations at the same time, but gold's been rising for quite a while, telling us that the CPI number they've been giving us was a bunch of garbage anyways, that it really was, inflation really wasn't coming down, and there's no way we're anywhere near 3%. We're at best near 8 or 9% inflation. Just look at your overall bills. And gold is probably, if I were to guess, and I was going to make a trade now because I'm a believer in gold, so don't take this the wrong way, anybody. I buy gold, I buy physical metals, which I am not selling, okay? However, I would, if I were trading, which I do, I would be looking to take a short position here for a 50 to 60 point drop in gold, because again, it is pretty overbought here. It's been a little bit overly exuberant, and I think that you're probably going to see somewhat of a pullback. And I think for the health of the market, it would be healthy to have a little bit of a pullback in gold here. If we're going to get to that potential 3,000 mark, you need to have a pullback to build some buyers and bring in some new money once again. I think silver has pretty much had a lot of its pullback already, and I'm not saying that it has and it can't go lower, but I'm just pulling up a chart while we're talking. I mean, it looks pretty solid. It is a little bit overbought here now as well after today's little bit of a rally, which is almost $1. Again, I think we're stuck probably right now between 30 and 32, but I would not be surprised at all if we saw 35 by the end of the year, and maybe higher. But again, I don't like to make dramatic projections of where it's gone. I mean, I think someday silver will take out the $49 high, which was made, I think, in 2011. But right now, I'm looking at it one level at a time, and it looks pretty good. It's come off the bottoms, which was about 27, and has now rallied nicely. The key here is going to get through this resistance level here. But I think, listen, I'm a big believer that the precious metals, gold and silver, you may need them as a currency at some point here, okay? And that's one of the things that's pushing these things higher as well, because I think people are finally starting to compute that the paper dollar, the scam, and the manipulation of the fiat currency system, which is controlled by the central banking system because they have no backing, may not be worth anything one of these days. And I might, to buy groceries, I might need gold or silver to go out to the grocery store. I think that at the end of the day, I mean, central banks have been buying gold forever. There's a lot of things you can do, a lot of arbitrage type of trade you can make. I mean, I can buy physical gold and sell futures gold, right? And make money and create an arbitrage or create a spread without any risk to myself, basically, if I have enough capital to do so. And it's no surprise. I mean, the Fed's been buying gold too, supposedly. Now, again, I don't know that factual, but I've heard that. But the countries and governments are always accumulating gold because that is the standard. And even though we went off of the gold standard and the other currencies around the world went off of the standard, doesn't mean that it still doesn't have meaning. It doesn't mean that it still isn't valuable to the potential of a currency, because when you start thinking about the paper dollar system, they keep reducing what the actual value is of a dollar. I mean, $100 bill today, 20 years ago, would be worth, it would have been worth $300.
Horwitz explains that banks generate income from the spread between their borrowing costs from the Federal Reserve and customer lending rates. Horwitz highlights the power of fractional banking, which allows banks to lend up to 10 times their reserve holdings, significantly boosting their profit potential. This explanation comes from the Federal Reserve's decision to maintain the federal funds rate between 5.25% and 5.5%. Despite this stability, the Fed's summary of economic conditions indicates that most Federal Open Market Committee members anticipate 3 rate cuts later in 2024. Horwitz interprets the Fed's approach as a lesson learned from past experiences. He suggests that by considering an early interest rate cut of 0.5 percentage point, the Fed is proactively guarding against potential economic downturns. Fed officials' projection of 3 rate cuts in 2024 points to a possible shift in monetary policy. This forward-looking guidance implies that while the Fed remains cautious about inflation, it is also preparing for a potential easing cycle as economic conditions develop. Let's get back to the interview.
Well, you have to remember that the Federal Reserve is not cutting rates for you and me, the American people. It's cutting rates for the banks to borrow from them. Okay, that's banks go to the lending window of the Federal Reserve. So what we have seen is we've seen a scam, is what I would call it, to cut rates to increase inflation so that the government can collect more tax dollars, because they can't raise our taxes, but they can certainly get us to, as they call it, the hidden tax of inflation. But since the rate cut, mortgage rates are higher. And of course, the 10-year notes and the 30-year bonds, which if you were watching them trade, they've gone down every day and they go inverse to their rates. So when they go down, rates are going higher. And rates, the 10-year notes have gone up every day since last Wednesday, when the Federal Reserve cut 50 basis points, which I had said would be a calamity and a disaster. And it's turning out to be just that. Well, I think it'll be a disaster. I think we're heading towards either stagflation or deflation. I think that the first you're going to see inflation spike once again, and that is a tool that governments use to get you to pay more taxes without knowing that you're paying more taxes. So when you go to the grocery store or your phone bill or whatever else you're paying, there is a federal tax on everything that you buy. So by creating more sales, by creating more price movement in those markets, they are creating actually more tax for the coffers of what they use. So at the all-time new highs, look, there's no volume in these markets. I don't put any credence into the all-time new highs. I see mass inflation coming. You're watching right now as the commodity markets have started to work their way much higher after being under pressure for years. Now they're starting to pop up pretty good, which means that when you go to the grocery store, you're going to be paying more money, which means you're going to be paying more taxes to the government. Whether you know it or not, that is a fact, that the hidden tax of inflation will continue to take money out of your pocket. And that's what we're watching happening. And that is the calamity of the Federal Reserve. People don't recognize, nor do they think about what they're spending. As long as they got checks and as long as they got credit cards, they keep spending money. And of course, prices are going to have to rise, because we've already seen that when you look at the goods and services that we use, they are starting to rise. And you know that the retailer who's selling you the goods and services is not going to give you a discount because they know the economy is bad. Listen, we're in a recession, okay? You have people that can't make it, that living from check to check. You've got rent. Last year, over 21 million Americans were paying 30% of their net income for rent. You can't live like that. You cannot survive like that. It is virtually impossible. And this has all been created by the lack of the Federal Reserve doing their job correctly, because they're way off mandate. They really have no business dealing with the interest rate market. That is not their mandate. Their mandate is inflation, is jobs and price stability, not manipulating interest rates, and especially to help a possible political candidate get elected. This was a horrible time to cut rates. because it would be somewhat of a benefit. But at the end of the day, I think we're seeing mortgage rates have risen since last Wednesday. Interest rates have risen. Prices have risen. And it's not going to get better, which is going to mean much higher inflation for you and me. Again, there's a spread, right? So the banks go to the federal loan and they borrow from the Federal Reserve. Okay. And let's say they're borrowing at 4.5%. There's now a spread that they have, and that's how banks make their money. They borrow money, they lend out, and by fractional banking, they have the ability to lend out 10 times what they're holding. So first they take the money they borrow from the Federal Reserve, they take that liability, turn it into an asset, and then they lend out 10 times that amount. But again, what they charge to borrow has nothing to do with the Federal Reserve. It has everything to do with what the bank is willing to loan that money out at. So we've all watched the credit score story, and the better credit score, the cheaper the interest rate you're going to pay. But they still, if there's a demand for money, they're going to keep interest rates higher and work on a bigger spread. If you're in risk capital, like a farmer, for example, the farmers always pay 2 to 3 points over normal lending. So as long as there's a demand for money, rates are going to remain high because the Federal Reserve only controls the rate from the federal funds rate to the bank. The bank controls the rates to the rest. So if the banks are keeping rates high, which they are, and they're continuing to go higher because the bond market is telling them that they should be higher, then the rates will stay high no matter what the Federal Reserve does. It just means the banks are making more money, to put it in real terms.
Gold and silver are poised for significant upward movement amid ongoing economic uncertainties. With inflation persisting and central banks adjusting their monetary policies, gold is increasingly viewed as a haven asset. Similarly, silver has stabilized after recent fluctuations, demonstrating growth potential driven by robust demand and favorable market conditions. What are your thoughts on the future of gold and silver prices? Share your insights in the comments below. We'd love to hear from you. Thank you for watching.